The recession, they refuse to see how economists, the Fed, and the markets got it all wrong. If you can cast your memory back to the chaos of 2007, you'll recall the first tremors of what we now call the Great Recession. But here's the astonishing part. Even as late as mid-2008, we were watching interviews on major television networks, appearing on the most watched financial programs in the country, and the so-called experts were telling us with straight faces, there's no recession. It was denial at its most dangerous. The economy was clearly unraveling, yet the people trusted to see the signs. Economists, analysts, even policymakers were completely blind to the storm already engulfing us. Only later, much later, did they go back and revise the data. They retroactively adjusted their models, acknowledged the negative growth, and begrudgingly admitted, okay, I guess we were in a recession, that's right. The country was already in deep trouble. People were losing homes, jobs, and their savings, and the guardians of the financial system didn't even know it. And here we are again. History isn't just repeating, it's taunting us. Today, we're in an eerily similar situation. If you look closely at the numbers, not the ones cherry-picked for headlines, but the real data, the signs of a recession are already here. We had back-to-back quarters of negative GDP growth. In economic terms, that's the textbook definition of a recession. But you didn't hear that on the evening news, did you? Instead, the third quarter came along and brought with it a 3% rise in GDP. On the surface, that seems like good news. But dig beneath that shallow headline, and what do you find? The entire gain was driven by a narrowing trade deficit. That sounds promising until you realize why the trade deficit shrank. Because we were exporting oil at record levels, pulled from our strategic petroleum reserve. That's right, we were raiding our emergency oil stash to create the illusion of economic vitality. But here's the kicker. That reserve is finite. By next year, it will be nearly depleted. And when that lifeline disappears, we'll be left to face the true state of our economy without the band-aid of emergency exports. Add to that the crumbling US dollar. In Q3, the dollar was relatively strong. Artificially so, thanks to aggressive interest rate hikes and misplaced faith in the Federal Reserve. But now, in Q4, the dollar is falling. It hasn't given up all its gains yet, but it's slipping fast, and that spells disaster for our trade deficit. A weaker dollar makes imports more expensive, further fueling inflation. So even if that Q3 growth wasn't a complete mirage, it was certainly a one-off, an unsustainable fluke. And when Q4 data comes in, don't be surprised if it's negative again. So why are we still pretending everything's fine? Why are recession deniers still paraded across screens telling us the economy is resilient? Because admitting the truth would mean acknowledging failure. It would mean the Federal Reserve's policies didn't work. It would mean that the experts, again, were asleep at the wheel. But denial has a shelf life. Sooner or later, the truth gets too big to ignore. And then what? Will the Fed change course? Or will it double down, raising interest rates even higher, tightening credit even further, and plunging us deeper into an economic quagmire? Let's talk about the dollar, because its rise and fall tell the real story. The dollar didn't strengthen because America's economy was booming. It rose because markets believed the Fed when it promised to bring inflation down to 2%. Investors thought, okay, interest rates are rising, that must mean real returns are coming back. But reality is knocking. Despite rate hikes, inflation isn't falling, not really. The consumer price index may be rising more slowly than before, but it's still rising, and that means your purchasing power is still eroding. In real terms, interest rates remain negative, and when investors realize that, the dollar will collapse, not just drift down gently, but fall sharply. That's because holding dollars only makes sense when the interest you earn outpaces inflation. When it doesn't, you're losing money, and no investor wants to hold a currency that bleeds value. Some might argue, well, it's not just the dollar. Other currencies are doing worse. And they're right. The euro, the yen, they've all taken beatings. But let me give you a metaphor that makes this clearer. Imagine you're walking backwards at 10 miles an hour. Now imagine the person next to you is moving backwards at 20 miles an hour. Relative to them, you're advancing. But in truth, you're still going backwards. That's exactly what's happening with the US dollar. Yes, it's strengthened against other currencies, but in real terms, it was still losing value. Just not as fast, but that trend is reversing. The dollar's relative strength is fading, and soon it will be falling faster than the euro or yen. A terrifying prospect for the cost of imports and inflation at home. When the media talks about inflation slowing, they rarely explain what that really means. Prices aren't coming down. They're just going up more slowly. And if prices are already too high, then slower inflation is like getting hit by a hammer slightly less often. It still hurts. We don't need inflation to slow. We need it to reverse. We need prices to fall so that Americans can regain some of the purchasing power they've lost over the past 2 years. But that's not what the Fed is aiming for. Its goal is to bring the rate of increase down to 2%. But that 2% is stacked on top of the 15 to 30% increase we've already suffered. So even if we hit that target, and we won't, we're still living in a far more expensive world than before. Now here's the irony. The Fed's biggest weapon against inflation, interest rate hikes, might actually be making things worse. How? Because interest rates are prices too. And just like any other cost, businesses pass them along to consumers. If a manufacturer needs to borrow money to build a factory, and borrowing costs double, guess what? Those higher costs show up in the price tag of the products they sell. Landlords with mortgages on apartment buildings? They'll raise rents to cover their rising interest expenses. Small businesses? They'll hike prices to stay afloat, and when smaller companies can't absorb those costs, they'll shut down, leaving larger ones with less competition and more pricing power. So, yes, rate hikes may suppress demand in theory, but in practice, they're also pushing prices higher. It's a vicious cycle. Let's take housing as a case study. Higher mortgage rates are supposed to cool down housing prices, and in some areas, they have. But what does that actually mean for home buyers? Not much. Because even if home prices fall 10 to 20%, the monthly cost of owning that home has gone up, thanks to higher mortgage payments. And it's not just the mortgage. Maintenance costs, insurance premiums, property taxes, all of it is soaring. So while headlines celebrate a correction in home prices, the real story is that it's more expensive than ever to buy, own, and live in a home. All of this leads to a critical inflection point. If we want to fix this, we need Americans to save again. Real saving. Not just storing cash, but earning interest that outpaces inflation. And that can only happen when interest rates are higher than inflation. By a wide margin. Right now, they're not. So people keep spending. They're racing to use their money before it loses more value. That's how you get runaway inflation. Too much money chasing too few goods. But there's more. When people save, those savings become investments. Businesses borrow those funds to build factories, create jobs, and increase supply, which in turn helps stabilize prices. So saving isn't just good for individuals. It's the foundation of long-term economic growth. So where do we go from here? That's the trillion-dollar question. Will the Fed stay the course despite the economic pain it brings, and finally force inflation down by encouraging saving and slowing spending? Or will it fold under pressure from Wall Street, from Washington, from the media, and pivot too soon, unleashing another round of inflationary hell? Whatever it chooses, one thing is certain: the current narrative, that everything is fine, that the economy is strong, that inflation is under control, is a fantasy. The data is clear. The trends are unmistakable. We are either in a recession now or about to enter one, and denying that fact won't change reality. But acknowledging it, that's the first step toward fixing it. If this breakdown opened your eyes, don't let it stop here. Hit that like button to help more people wake up to the truth the media won't tell you. And if you want deep dives like this, raw, unfiltered, and brutally honest, make sure to subscribe and turn on notifications, because in a world full of noise, this is where you come for clarity.